Hey guys, welcome back to our exciting series on commodities and commodity futures. This week, we're going to spotlight a new commodity, cotton. Now, we're not going to make this too over the top or too cerebral. We're going to try and make this as real world and as exciting as it possibly can be. This is going to be a beginner's guide. This is not going to be an in-depth look into the world of cotton. Really, it's coming from the perspective of a trader and how traders view cotton and cotton futures. With that said, hope you enjoy it. Let's get started. Cotton is one of the primary materials used in the production of textiles for thousands of years. The US, India, and China alone make up over 60% of global production. Out of all the fibers used around the world on a daily basis, cotton accounts for over 30% of it. Here in the US, cotton production dates back hundreds of years, prior to the US Civil War. Out of all the types of cotton that are produced in the U.S. on a regular basis, the most popular type is called American upland. This one specific type of cotton accounts for almost all cotton crop that is grown in the U.S. every year, at a rate of about 97% of total production. China, the U.S., India, and Pakistan represent the four major cotton-producing countries all over the world. Out of those four, the U.S. is responsible for the production of a full 1/3 of the cotton that is being traded. As a result, the U.S. is the world's leading export when it comes to cotton futures trading. Annual cotton industry profits in the U.S. commonly reach over $25 billion. In the U.S., cotton is traditionally produced in the southern part of the U.S. and parts of California. It's just like natural gas where there is effects of weather. So depending on the weather in these areas and the time of year at which the weather starts to get warm enough, production can begin as early as March. Also, again, dependent on the weather, the harvest can last all the way into December, if weather allows for it. The contract that we're going to be discussing is called Cotton Number 2. It trades on ICE, which was formerly known as the NYBOT or the New York Board of Trade. It controls about 50,000 pounds net weight. It trades in tenths of a penny, think crude oil, and each tick is equal to $5. It is a physically delivered contract. So what that means is that think just like oil, where oil goes from, let's say $60, so it goes 60.01, 60.02, 60.03, 60.04, et cetera, et cetera. Cotton works the same way. Let's just say $17.17, then $17.18, $17.19. Each tick is equal to $5. That's a brief history and a little bit of a fundamental picture on it. Again, we're not going in depth. This is more of just a guide to understand what it is that you're trading and to pique your interest to go more into the world of cotton. Let's get to the technical picture. Up here, we have an hourly, a daily, a weekly, and a monthly. As you can see, cotton pretty much, just like every other commodity, is range bound, which is what you would expect. You want prices to be stable. Range doesn't necessarily mean bad. It just means stability. In commodities, you're looking for stability. Producers, hedgers, they're looking for stability. They want to know that when they're creating their production lines, what it's actually going to cost them for raw materials, cotton being one of those raw materials. So therefore, stability in these markets is crucial. Let's just take a look quickly daily and we'll go from there. So on the daily, you could see there is a downtrend, but it's a very grindy downtrend, but it's still range bound within that. Now, just because something's range bound does not mean it's not tradable. It just means it's range bound. That's all it is. Don't overthink it. When you go out to the hourly, you'll see the same thing, but it is tradable. There are moves in it. Is it a blockbuster mover? No, but there are moves in it. There is money to be made trading. Now, let's just go over a little bit more of expectations when you're trading cotton. When you're trading cotton, your job, more than anything else, is to manage your risk. Now, the thing with a lot of commodities, with the exception of, let's say, gold and oil, they primarily all move basically around the same. So they're not speed racers, but they do move. So you have to keep your expectations in check. They will move. They're very tradable. They're very enjoyable to trade. They're very relaxing to trade. But again, they're not flying all over the place. So if you're looking for something that is flying every which way possible, cotton futures are not for you. There is volatility in them. When they start to go, there is volatility, but volatility doesn't mean flying up, down, sideways, left, right, all over the place. That's not good volatility. You want volatility that actually moves, that you can trade. Cotton futures offer that. Again, this was a brief guide just to pique your interest into the world of cotton. Cotton is one of the markets that I trade as well. I enjoy it. It's very relaxing. It's one of those markets you could just put your order in, put your stop, and set it and forget it, and then just let it do its thing. Thank you for watching, and look forward to seeing you on the next one.